This morning I had a head and shoulders on my radar. Left shoulder right here, head with thinking we were holding the neckline, we may punch up to a right shoulder. It doesn't look like that's going to happen, although it does look like we have a breakout forming, right? So we may need to go down to a lower time frame, but you can see the directional move down here. And then we get three kind of like indecision candles, right? You guys see these? These two greens and a red, three indecision candles, and they're slanted upwards, which makes it a little bit like a flag pattern. I bet this would be a flag on a lower time frame, perhaps. Very similar, not quite a flag, but a similar kind of upward move. What I would look for here is this. Oh no. There we go. What I would look for here is this. Let's look for, broken record alert, a violation of this level to the downside, right? So this is my decision point right here. We just start the hour, so we got an hour to figure it out. If we can violate this level, the next question is, where is price likely to go next? On today's episode of Where is Price Likely to Go Next, I want you guys to shoot in your predictive price point of where is price likely to go next? Insert cheesy theme music. Price, price, where are you going, price? Price, price, are you going lower, price? That's just the mock-up version. I'll get a Beyonce or someone or Lady Gaga to do it. Working on becoming a complete sellout. The Jim Cramer of Forex. Just bells and whistles and dancey people and cannons. And says 137.04. Are you avoiding a psychological number, Ann? 137.04. I got 136.98. Now we don't want 136.98, right? But looks like you guys are both choosing the same level, right? The zone prior to the elephant candle, right? So again, I would mark out this zone right here. You said because of the psychological, yeah, okay, yeah, I was gonna say, yep, above, yep. If you're gonna be 136.98, you might as well be 137.02. 4 pips, right? You might as well give yourself a little bit of safety for 4 pips, right? So I think a lot of you guys are looking at this elephant candle. We have the zone right before it, right? This candle right here, and this little, if you imagine this being on a lower time frame, this would be a new structure high and outside return. I think this is a solid zone on where price can go to next. Now, there's a few other things we can measure here, a lot of things actually. So if you're not familiar with Fibonacci, just bear with me because this could get crazy. We can do a few Fibonacci things here. We can do Fibonacci of the whole swing low, swing high. We have a 50% right in there, 618 lower. We could do a Fibonacci inversion, which I don't think is going to give us much. The extension would be the same, but a Fibonacci inversion from the swing high here to the swing low backwards and back up, which is going to put us above there. And a Fibonacci extension of this last move would give us the same thing, a little bit lower, but pretty much the same thing. No, it is lower, yeah. A 1618 right at the top. So we have a 1618 right at the top here, 137.09. A 50%, a little bit below that, 137.05 in the psychological number, of course. The last thing we can bring in is we can bring in some volume again. Swing to swing. And we see that we have a big void, right? This is what we like to see, guys. We call this the void. We have a big void right here. Now, is anyone not familiar with volume? And I guess the interpretation of this horizontal volume? Let me know and I'll explain it if kind of what we look for. And again, I call it horizontal volume because it's on the side of the chart and it measures volume from price points, not specifically from candles. But remember, if you're watching the recording, because I keep forgetting people are watching the recording, basically volume is synonymous, that's my big word, with interest. So where there is more interest, Interest is synonymous pretty much with support and resistance, supply, demand. Where there is more interest, those are the places where price is likely to kind of have a think. Things that make you go, right? Where there's no volume, that's like, imagine that being like a highway. Matter of fact, this is a better example. Matter of fact, I don't know if this is true. My wife showed me this picture of a 50-lane highway in China that merges into 4 lanes. Is that true? It can't be true. Is that true? Have you guys ever been? I never. It's a, sorry, off topic here, but yeah, it's a Chinese 50-lane highway that merges into 4. Oh, yeah. So here we go. So like high volume areas are like this 50-lane highway that somehow merges into 4. Yeah, I didn't believe it. I called her a liar. I looked her in her face. I said, don't you lie to me. We agreed on one thing in this marriage. We tell the truth. You liar. Who would be so dumb? So high levels of volume are like this merging area, this traffic jam where things are slow and could potentially slow and stop, where the void right here is typically like the Autobahn, where things are free flowing and going. It's ridiculous. Who would make that? Someone, whoever created that had to be like quitting the next day, and they were just mad. Like, how am I going to get vengeance on my boss? I know how. Someone mailed it in. Whoever approved that it came across their desk, and it was their last day. They're just stamping everything. Yeah, approved, whatever. I'm done. That's horrible. Horrible. I thought the 5-lane highways in like LA were bad here in the US. Horrible. So anyway, we expect price action to essentially smoothly travel through the voids, and then slow down when it gets to the volume spikes. Now, what's interesting in this situation is that there's really no volume either. I mean, there's more than the void, obviously, but there's no real volume in the level that we predicted. The rest of it comes lower. Now, again, this is where we have to understand, like in the last episode, the last example, where do we value things? If you value volume as your number one thing, then you may adjust targets all the way down here. But if you value structure and candlestick patterns and formations, then there's probably no way you're saying, I'm sacrificing this zone to predict that price is going to continue below that zone. So we have an idea, right? So we have our bias, right? If we break and close below, we have a short trade, we have a location right in this zone right here. I'm going to stretch this up and make it skinnier right in there. We've got our trade set up, guys. Now we go down to our lower, and you're asking yourself, how can I get involved, right? So we've gone through our IPDE. So this is where, understand what type of trader you are. If you're a breakout trader, you may be in already. As soon as we broke, boom, I'm in, right? If you're a super aggressive breakout trader. If you're a more conservative breakout trader, perhaps you're waiting for the break and the close, meaning you're waiting for this candle to close, right? And you're saying once this candle closes, or if this candle closes below, then I'm looking to get short to this level. Now, I'm not a breakout trader, but if I were one, I guess in this case, you can actually have your stops above structure. Typically, you want to have it above the breakout candle or somewhere within the breakout candle. I've experimented with a few ways here in the DKC, right? I would actually take a Fibonacci of the breakout candle and use a Fibonacci percentage of that candle to trade it. But that's typically how you would do it, because in many cases, you're going to get a really bad risk reward since your entry's so low. But that's a way you can do it. My preferred way is a confirmed break and a pullback. So wait for a confirmed break, wait for price action to pull on back, and then look to get involved somewhere in this area for that move down there. So this is a decent day trading opportunity, assuming we get this close, which we have 1 minute. And we did get the close. So there you go. You can look at this on the 5-2. And if you're really feeling fancy, right? My preferred day trading chart, the range bar chart, right? Which, funny enough, we don't have a break and close on the range bar chart. That kind of sucks. Well, I probably need a different one. What's our ATR? Oh, our ATR is so low. That's the crazy thing about these ATRs. Are so low. So a 3 range. You can look for a range bar chart as well. Just may have to adjust your range since ATRs have changed since my day trading days. But yeah, that's a really decent example of sorry, chart. That's a really decent example of a nice trend continuation day trading trade. And again, this same method could be used on a daily chart, a weekly chart, whatever it may be. It's all the same. It all moves the same. This one just happens to be here on a 15. So I'll get this into our pro trade log as well. This is a nice opportunity. There's another question that came in, but let me get this to our chat first. Give me a second. Lovely trading idea. Someone said an AB equals CD as well. Yeah, I forgot all about that. Let's measure it. A to B, copy and paste. Oh, baby. Who said that? Ali, you so good. Look at that. And a Fibonacci extension. Yeah, we kind of rushed through it. But yeah, the rest of we did the Fibonacci extension already. But yeah, that's the level right at that 1618. Burn. Nice. In the case of a pullback for entry, do you look for a retest of support that is now resistance? Yep. So we measure out the kill zone the same way we always do. We look for price has moved here. This was our previous low. This is the start of our kill zone. This is the end of our kill zone. So that zone looks something like this, right? At minimum, it must pull back to that low, and it cannot break and close above that high. So must at least come back to here, cannot close or violate that level. And that is the pullback zone. All right, gang, welcome back to round 2 of the Tuesday New York live trading room. We had a boring day in the market, but we're finding exciting stuff to take a look at. We left off with dollar Canada. You can see that we did get our pullback. And again, this is one of the luxuries of the range bar chart. Now, I didn't look at a minute chart yet. Let's see what that looks like first. If we're looking at a minute chart and a 15-minute chart, was there any way to get involved in this trade that you see if you are a pullback trader? Well, no, not yet. There still could be. We have no idea if this red candle is going to continue down or it could be green and go back up. But there's, aside from entering in the breakout sense that we talked about before, no possible way to get involved. Maybe if we go down to the 5-minute, you get a little bit of an inside bar pullback with a nice wick, high wick there. Inside bar and a lower low, lower close. You can use the inside bar breakout technique as an entry. On the range bar chart, something very similar, right? Range bar chart, you can see we got a pullback. We got a nice high wick candle here. We got another high wick candle there. Strong bearish candle, lower low, lower close. Boom, there's your entry right there. Again, entry at the close of that candle. Stops in ATR or 2 above. Again, our highs are 137.29, so that's going to be 32 or 35. That's a 1 to 2 ATR stop. If you want more than that, right, you can easily get above this structure as well. And if you remember, our target location was down at our 1618, AB equals CD, structure, all that confluence, about 137.10. So you're looking at a situation where looking for a move right back down into this zone, 137.10.7s, that area right around there. So you can see a pretty decent risk reward. Again, if you're being super conservative and you want to get above structure, you're looking at something like this, still a 1.3 to 1. If you're more aggressive and just saying, hey, I just want an ATR or 2 above this level, you're looking at 32 or 35, something more like this, and then a move down to this level. You can see either way, I'm sorry for having these overlap, that's a decent risk reward. Now the next part, especially with continuation trading, right? the next part that you want to add to your repertoire is active trade management. So you can see that we just broke and closed below this level. So if you're not going to be able to do much with the secondary one, if you're someone that took the higher stop loss right here, now the question is, right, we had a break and close below. A break and close below should confirm what? Should confirm what? This is no different than our normal analysis in the market, right? Should confirm a continuation down, right? That also, right, going back to kind of foundation course 101, right? If this is a new structure low and this is an outside return, this is a new structure low. As soon as we get the break and close below, this officially becomes what right here? What does this point officially become? Yep, now it becomes an outside return. And we know that if a trend is going to continue, this is our safety, right? Should this outside return be violated if we're correct in our move? Well, it should not. So therefore, right, do we still need our stop loss above the previous outside return, or can we adjust it to the new outside return? Right? Thinking from a safety perspective. Well, we don't need it. I don't think we need it this high, because if we know we're wrong here, why take on extra loss, right? So we can adjust it down below the next level that we need to be protective. Now, again, in this particular case, because the ATR is so small, you want to give yourself some breathing room because you can easily get stopped out by the spread here, with the ATR only being a 3. But that's the general concept of active trade management, is reducing your risk while the trade is moving in your favor. But are we doing so off of a feel, a gut feeling, or a fear? Are we doing so off fear or feel? No, we're doing so off of a technical reason, and that's how we stay consistent with it. So that's a good example of active trade management. And as a trend continuation trader, you're doing that all the way down until it gets to your targets. So if we do the same thing here, where we retrace here and then we come down here, guess what you're doing? You just keep rolling this bad boy down. Keep reducing it. It's a good feeling. Not as good as a feeling as getting targets hit. That's the best feeling. I think we'd all love targets to be hitting like a single candle right away. That'd be great. But the second best feeling is being able to reduce your risk. And while being able to reduce your risk, what it does is it reduces a little bit of your anxiety, it reduces a little bit of your fear, and allows you to stay with the trade and actually see a trade through instead of panic and get out of it.
I wanna be the best in the game, invest in my name, check no restraints, I'm obsessed with the pain, I ingest, I retain, assess and I change, possessed by the thought I'll be free one day from society's restraints, money, clout and fame, mud, disease, a plague, we all love to hate, have to play the game, have to make a name, all our insecurities are on display.